Good afternoon, everybody. My name is Dave Price. I'm the Director of Sales here at Rock Advisors, and I want to welcome everybody to today's webinar series. This webinar series is Financial Fundamentals of Apartment Development, and this is a five-part series. And the webinar series is designed to walk you through the journey of the financial components for apartment development. And we're going to start off with the basics, and then we're going to finish up with complex deals, financing, and private equity later in the series. So part one, it's all about the basics, understanding the concepts and the fundamental terminology. So now just to give you a little bit of a heads up, we've got some exciting programming coming up for later in the year. So on April 16th, we've got developer and investor roadmap to modular rental housing. This is becoming a more coming into more conversations as options for builds. So that'll be a real point of interest for many of you. Later in April on the 28th, we've got Women in CRE. There's a real fundamental shift going on there, and we're really excited to tap into that. Um, Now, as part two of the series that we're working on today, Financial Fundamentals, part two is about the development pro forma. Catch that one on May 28th. And again, that one's also a free webinar. And then later on in the year, mark the date here, December 1st is our apartment development and affordable housing conference in Toronto. That's live. And we're going to be doing our regular programming, expert speakers, but save the date on that one. That is a must attend event. Now, all of the QR codes are up there. Anybody has any questions or needs reminders, just let me know. I've got another save the date for you. If you haven't heard about the National Apartment Council, the AGM is later on this year on September 21st and 22nd. This is the largest gathering of apartment developers in Canadian history, and the National Apartment Council is the first of its kind advocating on behalf of the private apartment developers. And we've got Benjamin Tall as an expert speaker, guest speaker on that, and we've got more coming. So save that date. Now, we're going to cover a lot, like I said, of the basics. If you have any questions, please use the Q&A, the chat box in the right in the application. We'll be monitoring the questions as they come in, and we're going to have lots of time at the end of the webinar to go through these questions. But if it's timely and makes sense, we'll go through those as the webinar goes along. But don't be shy, ask your questions. Now, once the webinar is over, the recording and the slides will be made available. They'll be emailed out, and you can rewatch or watch the replay on YouTube after the webinar is over. Now, to get you started, so who we are and what we do. So Rock Advisors, we're apartment developer solutions providers. So many services that you can see up on the screen. We're involved in apartment and land brokerage. We have Canada's number one new apartment construction brokerage team. Feasibility studies, we've done over 1,000 of those in financial modeling. And now we've got a debt advisory service that really ties into financing options that really ties directly into feasibility and financial modeling. So we've got consulting services throughout the apartment development timeline, and we run educational series. We've got tools like Apartment Development University, and we run live events throughout the year, like the one on December 1st. Plus, we've got a full service lease up consultation service. Now, the markets that we work in, you can see them up on the screen there. We are specialists in new apartment construction. And given the current state of the market, a lot of our clients, our new clients, are pivoting developers coming into rentals, and we can show those developers the nuances of the differences between rentals and condos. Affordable housing is a major topic. We'll be covering some of those today, that how they impact the financing deals, and we'll get into a little bit more of that as we go along through today's webinar. Now, as I mentioned at the onset, this is a five-part webinar series. Today, we're going to focus on the fundamentals and the basics, right? So some of your questioning might actually tap into what we're going to get into later on in the series. So you can see part two is on the development pro forma, CMHC options in part three, and then we're going to get creative with you how equity deals and joint ventures tie in and may be necessary to get some of these deals capitalized and financed and private equity in part five. So a really exciting and informative series, and we're going to build as we move through the through this five-part series. Now, we've got a couple of excellent expert speakers that are going to share some information with you. So, first of all, we've got Rod Schulhauser. He's the COO of Rock Advisors. And we've got Joanna Zhao, our Director of Debt Advisory here at Rock Advisors. So, thank you both for joining us today. We've got a really interesting hour in front of you, and let's get things started.
All right. Well, thanks, Dave, and looking forward to Joanna. Thank you for joining us too. And I'm going to kick things off because, as Dave, alluded to, this is really meant to be that introduction. So for those seasoned veterans, it's good. It's good overlap to what you already know. Some things are intuitively obvious for you, and you may want to dive deeper into certain elements. But I'll just ask for your patience because the goal here is to really start from first principles. Start to seed and plant the thoughts about how the next detailed dive into the pro forma fits in. But what you see up here is really just a simplistic representation of what we'll call the apartment development timeline. Moving from the land and land acquisition phases through feasibility, the financial elements of modeling and actual financing. Of course, there's the construction design elements, and then those three phases, those critical phases of marketing, lease up, and revenue management that really, have a huge impact on the asset value, and then landing finally on disposition. Disposition meaning, is the building being sold and then the next project starting? Is a portfolio being developed? But this is what we're going to call the apartment development timeline. So let's now layer in, what we're going to be talking about here. So why? So why are there these various stages, and what are some of the topics or metrics or important elements of that? So when we look at feasibility, you see something called the big question. The big question right up front is all about, is a developer building this building to sell it, or are they building it to keep it and become part of a portfolio? Because that does impact the plan of attack on the development project. But at the end of the day, feasibility is all about instilling and developing confidence inside of the developer for them to go, yes, things are lining up, let's push go. And that's really what feasibility is all about. Now, what they look at, what are those variables? There are elements such as should they build, where should they build, what should it look like, what's the unit mix? So how much of each of those elements, and does it work at the end of the day financially? Does it work in the marketplace? These are the variables that are dealt with by the developer in that step. Now, when you look at the next two elements, modeling and financing, it's centric to building the capital stack for what we're going to be talking about here today. And some of those metrics deal with things like hard costs, like the construction itself, soft costs like development charges, architects, things of that nature, the cost of debt, actually financing it, the valuation, and estimating the valuation. Because at the front end, you're dealing with a lot of estimates. There's cash flow analysis to look at how that looks moving forward through the project, the actual revenue and expenses, because when you have a finished product, these become critical pieces to the puzzle. Now, when you move on to the execution, there's the design and the construction. But from our perspective, we're going to think about amenities because those are variables in terms of what they should not do. How do they adapt to their target rental market? What about economic changes? I mean, we've dealt with that over the last few years. What happens if the economics change in the actual project's timeline? Interest rates change. A bank or a financial institution is calling or changing some terms, and that impacts obviously variable hard costs because cost of materials, labors, and the such can be impacted. So those can become variables. Now, as I mentioned, those three other phases: marketing, lease up, revenue management. We'll call that the phase of leasing up to stabilization. Stabilization meaning you have a product that has renters to a significant, general completion term. It's not 100%, but there's terms that are set to actually define stabilization. And the variables here are rent factors. And we'll talk a little bit about those, but there are rent factors that are very, very important to pay attention to because rent is singularly the number one impact on the asset value when it comes to, getting to the finish line. And of course, vacancies is the reverse to that factor as well. But we'll dive into a little bit of that later on. And then at the end of the day, it's all about that selling, that keeping of the building, and the variables here come into, okay, what was we estimated at the front end, but now that we've reached the finish line, what does revenue look like? What is the rental income? What did it actually cost us? We estimated certain things, but where did we land? And of course, there's the valuation of the property, a sell price if they're moving the project. And so these are the stages of apartment development and the key critical factors. Now, what we're going to do is we're going to look at some very, I'll just call them entry level, the basic metrics from two different perspectives. One is that where this first slide is going to be about from the perspective of the developer, and then we'll look at the perspective of the financiers or the financial institutions. So the first metric that developers obviously care about is something called NOI. This is the net operating income. And you probably heard operating income. You probably heard that throughout your career and life. But basically, it's just the gross revenue, the amount of money coming in minus the basic operating expenses. That is the NOI. Now, you'll see each one of these. We actually give you a little bit of, I guess, touch points to think about. There's the formula, but it is a measure of another way to think of it. It's a measure of profitability. And there's some guidance here. 75% of gross revenue is generally not bad. Below 65% is considered low or poor. Now, remember, these are subjective because these also have to be translated into the current marketplace. If you're in a very robust marketplace, that may slide these variables in one direction, or if you're in a marketplace like we are in today, they may slide the other way. So everything is subjective here, but I want to give you a sense of, I guess, just getting an idea of what does it mean if it's high, what does it mean if it's low. So NOI is the first metric we're going to look at. The next one the developer really looks at is something called development yield. And that's that net operating income divided by the total cost of the project. And why is it important? The developer looks at this as, is my project viable? Does it make sense? It's an estimate of the developer's potential profitability, et cetera. And 5 to 7%, not a bad number to shoot for. 3% and lower is considered low. But again, it's not a make or break number. It all depends upon other elements surrounding the actual project, but you get an idea of the development yield. Now, the third one is yield spread. It's basically the difference between that development yield and something called the cap rate, which we'll look at next. And this just looks at the project feasibility and profitability. And you're looking for a good solid 1% or greater to really look for that separation in the spread to really, I guess, have more certainty towards profitability. Now, that cap rate variable we just talked about, the capitalization rate, is an indicator of potential profitability. Now, these cap rates are often, estimated. They are actually not something you make up. The market actually dictates what the cap rate really is. Like, what is somebody willing to sell for? What is somebody willing to pay for that asset? That really, at the end of the day, is what matters. But it is a measure of both investor demand, and it also, as we're going to explore, it determines and has influence over takeout financing, which is one of the two critical pieces we're going to dive into today. And obviously, a lower cap rate means a higher demand, greater value. And we'll see mathematically, even in the formula, as to why that makes sense. Okay, so let's look at that second bucket. That second bucket was, basic metrics from the vantage point of the financing entities, the financiers, the institutions, et cetera. And so at the front end of the project, there's definitely a financial, phase that has to be looked at. And from the lender's perspective, LTV, or the loan to value ratio, is one of the critical metrics they look at. And they look at this because it really is used to assess risk, because they have history. They look at loans being repaid over time, marketplace, et cetera. So lending institutions take the loan amount divided by the estimated property value down the road. So again, it's an estimate. And typically a 60 to 75% is somewhere in the range of what they're looking for, but it all changes. It changes with marketplace, it changes with dynamics, it changes with the lender. But loan to value is definitely an important metric used by these lending institutions. Same thing with debt service coverage ratio. You'll hear DSCR used quite often. It's that NOI, that net operating income, divided by the annual debt service. So that's both principal and interest put together. And you see right here that this is really just ensures a property has the ability to generate enough money to look after their debt, their payment of their loan. That's really what the perspective of the lender is. And 1.25, 1.25 or higher is typically required by lenders. Now, CMHC, we're going to talk a little bit about CMHC today and in our next webinar. The threshold is a little bit lower for them, which is one of the advantages of CMHC, and you'll see that in the example we'll use. So it's below the 1.25 threshold. Now, we also have a third one that now we're not going to talk a lot about debt to equity ratio, but I want to put it up here because it is looked at, but we're not going to talk about it in this examples of this webinar. But you can see it's the total project debt divided by the total equity invested, and you can see the 2.1, the 2 to 2 to 1 ratios that they look for. But again, just give me some general guidance when you hear the debt to equity ratio used. At least we've just covered or mentioned it here from that perspective. Now, you'll notice how we've got two gold backgrounds here, and there's going to be two pieces of the financial picture we're going to talk about. That is construction financing, which is the money that the developer needs to get their project going, to buy the land, to start bringing on board all the materials, the contractor, have enough basically to start the project and get shovels in the ground. And that financing tends to be what I'll just call it's an interest only payment to just keep you going till you start making money. And that's what takeout financing, the second one's all about. That's actually when you get into a conventional style loan or mortgage, but it's also a critical opportunity to change from the early on finance money into what we'll call an operating units money. And we'll talk about the reasons why that's important here momentarily. So those are the metrics that we're going to talk about. Now, what I want to do is kind of let's get more practical, and we'll actually even land on a simplistic example as well. Now, assembling
And
the project
Rod,
money is very important.
Rod,
Yes,
can I
Dave,
just I'm just going to interject here. It's really
and
interesting.
dive in.
You're talking us through a lot of the ratios and the metrics that are looked at, and you're talking about soft cost, hard costs, all of that. What's interesting is the revenue is such an important piece. And in the early planning phases, it's projecting the revenue, right? The one thing I don't think developers realize is where they have the most control is over affecting the amount of revenue that the property can derive, right? And why do you think that is?
Well, it's a good point because often when you're dealing with a huge loan here at the construction loan level, you're focused on. I mean, remember, if you're the developer, you're signing the covenant. It's your name on this potential profitable element. You're also responsible to the other side. So it's often we can find that a focus gets placed here rather than focusing here when you're financing the conventional. And Derek, our CEO, often uses the term short shrift, meaning that there can be the tendency for developers to give the lease up and these factors that really determine how much revenue the finished product can earn. And too much focus goes in on design and managing costs and saving dollars here. Yes, it's important, but at the expense of the revenue side of things, it can be the make or break between leaving literally millions of dollars on the table. So I think that's that. I hope that answers your question. Let's dive into that a bit later too, because I think that's a critical one.
Yeah, sounds good. Thanks, Rod.
All right. So let's now assemble the project money. So something called the capital stack. And remember, this is the developer who's now assembling the money because they don't have all the money themselves. There's going to be a big chunk of money needed to build this building. And that construction financing, the term often used as senior debt, is the significant portion of it. And then there's an equity component where the rest of the money has to be brought to the table because institutions aren't going to loan 100% and assume 100% of the risk and so forth. And so there's other layers of financing. Mezzanine is like a bridging financing to make up some shortfalls that may come into the process. Preferred and common equity. Now, all three of these kind of fall into the equity and mezzanine components. We're not going to get detailed here, but we will in our next webinar when we dive into the pro forma. But this capital stack's important because debt and equity are the two major components. And really starting at the bottom and working your way up to the bottom, you see it on the left-hand side, that's kind of your risk factors where The senior debt's going to be paid back first, and then so on and so on as you move up the capital stack. So that's what the developer is looking to accomplish financially in order to get their project and get shovels into the ground. So now let's talk about what's going to happen. So once a project is financed and the capital stack is built, here's what you look at. There's certain estimates and certain predictions that are made at this phase, but let's take time and value. And remember, in the background here, we see that construction timeline. I'm not going to start layering this component in. So they start construction, but somewhere down the line, 1 to 2, maybe 3 years down the road, the building is going to reach stabilization. A certain level or a certain percentage of the units are rented, the income and rental income is being realized, but also the impact is also on the market value of the building. It was a certain value when it was being built, and it tends to increase in most circumstances when time goes by. Because remember, this entire timeline can be 3 to 7 years in entirety. But these are the two big factors that we're going to look at here. Now, Dave, you said at the beginning, I'm going to reiterate it here. I'm going to go through an example that's going to be extremely simplified, especially for those that are in the industry that are financiers, and they may look at this example and go, yeah, I wish this was the way it was today. It clearly is not. I'm going to use numbers that are meant to make points. They're not made to make sense in today's current marketplace or represent that. So I want to make sure we're very clear here. I want to get the concepts behind the metrics across, not realism. Okay. So let's take our capital stack. So in this example, I'm going to say we have an $85 million anticipated expense at the time of construction building, and we're going to have a capital stack with a construction loan of almost 64 million. And I'm going to simplify the equity into one chunk, and we're going to put 21.25 million. And just again, simplify. And so this building now is worth $85 million now. But we're going to assume a number of years down the road, 2, maybe 3 years, whatever the construction phase is, that $85 million building is now going to have a market value of $105 million because time's gone by, because now there's rental income, and for a variety of reasons, it's worth more money. And so that's the example we're going to work through. Now, at the early stages, pretend we're now at the beginning stages of the project, we're going to make an assumption at the time of the early stages that a cap rate is about 4.5% for the sake of this example. It's an assumption. And we are going to base on using the cap rate and the value, because we know the value of the building and we know the cap rate assumption. And by simply changing the formula around, we can get NOI, or an estimated income or net operating income at stable of this project, as being $4.725 million. And so that is the cap rate we assumed. The NOI was simply calculated from the formula that we used. And those are two very important elements. The last one, let's look from the loan or the lender's perspective. Let's look at that loan to value ratio. And we're going to use a CMHC loan, which permits a 75% loan to value. We're going to take our construction loan. We're going to divide it by the value of the building, 85 million. And now we have a loan to value ratio of 75%, which is justifying and will work with the loan. So let's summarize this now. We have a capital stack with a 63.75 million construction loan. Now, this loan, very important for those that are not fully aware of this loan is an interest-only loan in order to maximize the debt exposure or the cash flow to keep it rolling. So it's interest only. There definitely are premium terms associated with it. And it's not a long-term loan. It's meant to just bridge the construction phases till money is being earned by the asset. We had our equity amount, we had our calculations we just went through. So that is where we are at the construction loan element. Remember, that was the first of those two gold boxes when we looked at that entire timeline. Now what we want to do is look down. The years go by. We've now reached stabilization. And now we're at this thing called takeout financing. And takeout financing is we'll call it more of a normal mortgage. It is conventional with longer terms, better interest rates than the interest-only loan that you would have seen in the construction loan pieces. CFP gets involved here as well, and that's typically insured by them. As I said, better terms. And the takeout financing has a very important purpose. Now, not only is it to get rid of the higher interest only payment scenario of the construction loan, but it's also an opportunity for two things to happen. Number one, there's an opportunity to take out a loan where capital, raw money, can be extracted from the project, where now suddenly investors can be paid off, the developer can extract financial equity and money from the project to use for other things, maybe another project or what have you. So it has a purpose. So now I'm going to show you how that purpose is accomplished and what it could look like in this example. So the first thing we're going to look at is we're going to figure out what is the maximum amount of this loan we can possibly accomplish so we can extract as much cash as possible from the deal. So if we look at that LTV, that loan to value ratio of CMHC allows up to 85%, we can take this formula and now solve for the loan amount. So for those algebra or those calculus related people, you know that if you take property value, move it to this side of the equal sign, then loan amount simply equals the LTV times the property value. Well, we know the LTV is 85%. We know the value of our building because we said we're now going to have a building worth 105 million. So therefore, we can calculate the maximum amount of a loan that we can get out given these terms and conditions is just shy of $90 million, 89.25 million. So why do we do that? Well, there's some obvious reasons we're going to do that. But before we get there, let's make sure that loan also makes sense because the institution doesn't want to blindly give away that money just because this calculation worked. They're going to do a debt service cover ratio check. So here's an example of the check. We know that the DSCR is NOI over the debt service. So in this case, we know the debt service because we know we have a debt of 89.25 million. Let's rearrange our calculation, solve for debt service, NOI over the DSCR, which at CMHC terms says it's 1.15. We take our net operating income. We're going to assume that what we assumed was reality and achieved, again, for simplicity. And we see that the debt service is actually 4.1, just over $4.1 million. Now, because we assumed our calculated NOI at 4.725 million is what we actually accomplished, I'll use a circle here. This 4.15 is definitely less than what we said our NOI was. And yes, it's confusing because I'm circling it over here with construction loan, but we're assuming that's what we're achieving in this building. So this is a check. Is enough money coming in to cover this demand for servicing the debt? And the answer here is yes. But that is a for instance of the kind of check that a financial institution will do. Now, yes, I know it's much more complicated this, and there's different numbers and there's different things that'll happen. Concepts, people. I just want to get concepts across. Dave, I'm going to pause right there very quickly. Anything to be chimed in on before I just kind of wrap things up here and summarize this simplistic example?
Yeah, so I want to throw a question out to Joanna. Okay. Now, looking at your the equity requirement, right? When you're looking to build the capital stack, is it reasonable for a developer with a parcel of land already, the equity that's in the land, is it reasonable for a developer to go into building the capital stack thinking that they have enough equity just in the land? How often does that play out that way?
That really depends on how the pro forma has been built up. So, and it also depends on, so here's like how the lenders seeing how equity should be put in a project. So first they will calculate the project cost. Project costs include land, soft cost, like interest reserve and hard cost. Let's say the construction cost like is 40 million. And what we're seeing is how much is the maximum loan amount we can get from a lender. That usually, like right now, loan to value is really not a constraint for the maximum loan amount. Usually it's the DSCR, the debt servicing coverage ratio. So if the debt service coverage ratio can support a higher loan, let's say the project's built in a way which they can achieve very high rent, and with a 40 million construction loan, they can go up to, let's say, 37 million loan as the takeout. The minimum requirement of the equity would be just 3 million. But if you are building up a 40 million construction project with a lower rent and the maximum loan amount you are going to take out would be 30 million, this will require you need to put 10 million as equity into the project. So that really depends on the performer. Let's say the land is 5 million. For the first scenario, it works, but for the second scenario, it doesn't work.
Yeah, makes sense. And when I'm thinking about this, or developers are thinking about this, oftentimes I think maybe you can comment on this, Joanna, getting an appraisal for the land value, updated and current is absolutely necessary, right? Because again, you're projecting value. I see myself a lot of times developers have an old appraisal or an old evaluation, that obviously is going to tie in directly to getting that updated.
Yeah, exactly. Sometimes lender is very strict at the land value lift. So we need to underwrite those numbers or provide those comparables or those costs very in a very good package to support what we can achieve as a land lift.
Yeah.
Right.
And we start
Yeah.
to see it
And
in even some of the questions, Dave, that, in real life, yes, the comments I see are 100% accurate. And even the question about equity. And again, we're simplifying here. I mean, but we definitely see pressures, especially in today's world, the pressures on the equity components and the realism behind estimates and numbers that banks are willing to accept. That band is narrow in terms of their tolerance.
yeah.
It's tighter. It's much less predictable than what it was 3.5 years ago. And we are dealing with it. But let's reserve those deep dives for maybe even later on in this webinar, but certainly our next one as well. So should I move forward, Dave, or anything else?
Yeah, I think so. Yes.
All right. So what I want to do is kind of just summarize, and really that's where we're going, is like let's look at the summary of the takeout scenario. So remember, the idea of takeout was an opportunity to pay off investors if that's what had happened, if a variety of partners had come in to be, equity suppliers of capital. And also the developer wants to extract physical cash out of the deal for many reasons. So in this case, we see that we had the takeout financing amount was just under $90 million, and it was limited by the LTV, that 85% threshold on the value of $105 million. So that was one of the key elements we came out as a summary from the takeout financing. And obviously the takeout summary, that it was to pay off that $64 million, just shy of $64 million construction loan, because we want to get rid of that interest loan and those higher taxing terms of the loan. Cash out to the developer in this case was $25.5 million. And that is equity extraction via this financing transaction. And don't forget that from the developer's perspective, they have something called retained equity, meaning that the building itself now is worth $105 million. And now they have a debt of almost 90 million. So there's a difference, and there's some equity that's built into this building, which is important depending upon whether they're selling, if they're selling, it's more important. So, but it's also a good measure of how they did for self-performance and things of that nature. And again, just to reiterate, this was all done with an 85% loan to value ratio in this example. The last summary I'm going to put up here, Dave, before I really start to summarize with 2 slides, is really the developer return. So the developer, if you remember, we just created an equity piece of $21.25 million. That was the equity. Realistic, no, but I just made it one number just for the purpose of this example to simplify. We saw the cash takeout from the takeout financing. Here it is. The total profit generated was the difference of, this is gross profit, by the way, 105 million, that value of the building versus the initial value of the building. That's how we got 20. And we already talked about the retained equity. Now, these are all four discretely different measurements. And just for an example, I just ran through a cash flow analysis. This building, if it were real in a world, it would yield close to $1 million positive cash flow, using a good secondary market's achievable rents, just to give you a completion to the picture, just to get an idea for $100 million building, what is it making? And so that's the purpose of doing that. So let me wrap things up before I turn things over to Joanna and Dave here. And let's just summarize what we went through, okay? So we talked about the front end of the development timeline. We talked about Key metrics, you see them there in black, the NOI, the cap rate, the development yield. We talked about 5 questions to be answered. Should I build? What should I build? How many units, the unit mix, what can I expect to make? But they also, up at this area, at the front end of the deal, NOI is being estimated. Construction's costs are being estimated just before they're about to go in. Valuation at the end of construction is being estimated. Cap rates are being assumed based upon market, and we're targeting a development yield somewhere in 5 to 7%. Now, what's the whole objective of this front end phase? It's all about developing confidence and it to put the developer in a position to acquire and finance the deal. We talked about the financing. There will be equity partners. We'll dive into that in our next webinar. We built a capital stack. The LTV and the debt service coverage ratio were two metrics that the financial institutions really care about to look at whether they can finance and how much and what the terms would be. And then we talked about that third phase. Dave, you asked those questions earlier, but this is going to be a critical phase. That marketing, lease up, revenue management. Rents have the largest impact on the value of a property. There are 5 key questions. I alluded to those at the outset. And, we said, should I build? Where should I build? What should I build? What does it look like? How much should I ask for it? How much should I build? These all impact what rents you're going to achieve, but the rent itself is impacted by factors. And I know Dave will talk about that in a few minutes, but these are elements that we definitely want to look at. And then disposition. Now we're dealing with the NOI that was realized, the actual NOI. Now we're dealing with a cap rate that exists that the marketplace determines by, if there is a transaction to be had. And so you can see right there, we now have stabilization factors, and it's obviously developers will compare that to what their estimates were. Now, as I mentioned, we'll do a deeper dive into the money, the time, the impact of marketplace. We'll talk about stress testing. It's much more than one spreadsheet with one number that developers are looking at. They're going to look at scenarios. They're going to look at, what if interest rates go up? What if interest rates go down? What if rents go up? What if rents go down? What is the thresholds and what are the stresses that I can tolerate when I'm guessing at the front end of the project and modeling out the results? And I'll conclude with this. Let's look at those key variables. The project cost me so much money. At the end of the day, when I finish the building, the property value as achieved. There's a gross revenue that was achieved, rents, and there's expenses. And so we talked about the NOI, the profitability, the larger the better. Of course, if you can make more money than you have as expenditure, obviously it makes sense. The cap rate, this is often people confuse the cap rate. The best way to understand cap rates and to know, is it better to be high? Is it better to be low? Look at the formula. It's very simple. NOI, the amount of money that you operationally have as a positive cash flow, the number of the cap rate gets smaller and smaller when you divide by a larger number called property value. So if your building's worth more and more and more, assuming NOI stays constant, then the cap rate will go down. So from the developer's perspective, a lower cap rate is better from their perspective because that means the property value went up. And you can just typically, in today's marketplace or what have you, but 4 to 5 in general is what is being used. But again, remember, the market really determines what the cap rate is. The developer doesn't get to decide what that is. Development yield, we talked about that. This is the potential for return on their investment. And a 5 to 7% target for that development yield is definitely what they're after. And lastly, the spread. Developers will look at that development yield, compare it to the cap rate, and they're looking for a 1 to 1.5% spread between those two numbers, because the greater the spread, the more the deal is de-risked because they've got some flexibility for contraction. Of course, they'll take expansion, and that's what it's all about. So, Dave, that's kind of a wrap. I know that again, as I said, for the seasoned veterans, this is going to be like the back of their hand. They know these formulas probably better than you and I, right? But I wanted to put it together in a story and an example to kind of talk about the basics. We're not diving into all these other factors that we will explore, but why don't I turn things back over to you and we can talk about key takeaways and things such as that.
Yeah, thanks, Rod. I think that's a really good framework. And again, to your point, we've got a large audience on here today of
Sorry.
varying skill sets and experiences. Um, I want to start by, Frank has just reached out and said, is vacancy allowances included in the NOI? Now, Joanna, maybe you can talk a little bit about that, especially, when you're in the early planning phases, these are projections, right? So
Yeah.
talk to us about how vacancy allowance is factored into the NOI projections.
Mhm. Yes, exactly. So vacancy allowance should be included in the NOI. So in our next webinar, we will dive this deeper. But the question is like how we get net operating income. They are from gross rent and minus like vacancy, and then we minus operating expense and operating expense including property tax, insurance, utilities, and other like some benchmarking expenses from CMC, like management cost, property management costs, like repair and maintenance reserve, things like that. So for sure, vacancy allowance affect and like the NOI. When we submit a loan, we would always want to have a lower vacancy be accepted by the lender because the lower the vacancy we submit, the higher the NOI will come from, and then we are getting the higher loan amount, which is every developer would like to achieve. But however, we need to find strong support in terms of where's the market vacancy is. And if we are suggesting a lower vacancy compared with the market vacancy, we need to provide very strong rationale behind it. Let's say we are located in a very good neighborhood, which the neighborhood we don't have any vacancy on the compare like the neighborhood apartment building. That would be a good example for our supporting our using lower vacancy at our loan application. So yeah, so in different way for sure.
Yeah, and I think to your point, really, it speaks to it's critical to get your in-depth feasibility study done in advance of going to secure financing because it's in there that you're going to look at the comparables and the apples to apples comparison of your project, the location, the area to provide that proof
Right.
to justify a lower vacancy rate if that actually exists in your market.
Mhm.
And I think one of the first points, and Joanna, to this slide, the focus of today's webinar is on the basics. So I think we've got a good foundation set here, and we're going to get deeper into some of these impacts as the webinar series goes along. But maybe you can talk to us a little bit about point number two that's up on the screen because it ties into some of the questions that are being asked by the audience about the assumptive model that we put together.
Yeah, for sure. I have some questions regarding CMC does not allow equity takeout. I will answer that later. Before we get into the, so I believe the key like the key message we want to deliver today is just like getting laid out those fundamental numbers which we should think about before we get into build a building. So like it's this like just like basic numbers. So it just determine whether a deal will actually move forward. And it's very simplified, but the relationship between those numbers is real. So, and especially like in today's market, construction cost is higher and interest rate is still high, it's still like elevated and rent growth, it's not like always keeping up. And we've seen last year, 2025, CMC announced the new rental survey, which indicates in almost across Canada, we are seeing lower the rent is decreasing and the vacancy is increasing. So that is like every developer should be keep in mind to how to design and our next project.
Yeah, and on that note, I think I mentioned we've done over 1,000 feasibility studies. And in there, we look at the vacancies of the comparable properties. And, we are seeing in a number of areas that vacancies are up, but I don't want everybody to have a takeaway that it's a disaster scenario out there because it's not. When you look at developers typically used to 1% vacancies or less, you know, a shift there represents maybe 1.5% or 2% vacancies in reality. Now, reality given a certain market may be very different from what the lenders or CMHC are willing to underwrite at. So, getting the support in your market to show vacancies at that tighter gap range is really critical to help support why CMHC should not automatically force a higher vacancy rate into their analysis. Um, Now, from a demonstration purposes, Joanna, I think you hit the nail on the head. The relationship in the examples that Rod took us through is the key takeaway here. We want our developers and listeners on today's webinar to understand that relationship in the numbers and start planning that way and thinking about it the way it was structured by Rod. Because now, and we'll get into this more in webinar number 2 about the pro forma, but it's about stress testing. It's about sensitivity analysis. So if you can grasp the fundamentals and start thinking this way, you can test for fluctuations. Because some of our listeners are asking about the reality, are is that example achievable in today's marketplace? Well, maybe, maybe not, but it sets the framework you should use when you do your projections. So now, Joanna, talk to us about the lease up phase and how important that is and why.
Yes, so the lease up phase is very important, especially when you are with a construction loan. Like no matter you are doing a conventional financing during the construction or you're doing a CMC financing, you will need to face certain level of stabilization of your rent to get your loan being taken out to a long-term, lower interest, sustainable loan. Um, I've seen a lot of cases when the developers they are keep building the project, but they didn't start the pre-lease at like maybe three to 6 months before they hit the substantial completion, which were just like longer their takeout time. They will need to spend more time to sit on the higher interest construction loan and it will cost the profit of the project as well. Yeah, because um, uh, 1 or 2 years ago, CMC can allow people could do like EGI not met, means you haven't achieved your rent, but you pay higher CMC insurance premium. You can get take out like right away. But then CMC and the lender have seen those risks, so they kind of very like right now they're very strict as the stabilization before they can take out the loan. I've seen they have like, so the CMC might have different from case to case. Some they require 80% of the lease should be getting, they should get at least like 80% of the lease and then they can do takeout. So
Gotcha.
I would say pre-lease would be very important, especially if you are running a larger project, which include a lot of units. We need to allow some time for the market to absorb this new rental supply.
Yeah, and if you don't start early enough with your awareness campaigns and your marketing campaigns to drum up that awareness and interest, you're always going to be chasing that exposure you're looking for. So yeah, lease up velocity is critical, but achieving the highest rents possible is critical for that takeout financing and making sure that you still have the debt service coverage ratio intact at time of takeout. So
Yeah.
Rod, Rod and Sarah, let's move to the next slide here. And let's talk about the value of CMHC. So, Joanna, why is CMHC insured construction loans important? So talk to us a little bit about that.
Yeah, this is like very simple question why every developer loves CMC insured construction loan because they provide higher leverage up to 95%. If you achieve some certain social outcome, you can get 50-year amortization, which means once you get longer amortization, you can get like lower debt servicing ratio because your debt servicing will be lower among those longer amortization. And also with CMC insured loan, the construction loan interest rate usually be a bit lower than conventional construction loan. So yeah,
Excellent.
and most important is not the most important thing would be the equity required because they can allow developer get higher leverage, which means they require less equity to start construction. So that is the 3 points which attract every developers to this program.
Gotcha. And, you know, feasibility, how does that tie in?
Oh, right. Yeah. Yeah. So here is what I faced when I have a client coming to me. Usually I got approached by a client. He would tell he tell me he told me I have a land which is like this cost and then I want to build 100 units. Tell me how much I can get from CMHC. I'm always telling my clients that they know CMC can offer them to get a higher leverage construction loan. They can have 5% equity to start construction, which make the program very promising. However, I'm always telling them you will need to decide like how you want to build the property, the project. Let's say 100 units. How big are they? What are the unit mix? Uh, what and have you done a market study of the land? Because the like this is different from you are developing a condo because for this is purpose-built rental, we need to keep in mind like how much rent you are going to achieve, and this will tie in with um, if if you have like different target renters, you will have to design your building in a different way. Like maybe senior, like bigger units, and young professional, like more compact units, which we really need to consider how we are going to build this building based on like 2 years later, they need to list up and we need to attract good renters in the market. And also amenities, they need to have very good amenities to attract good renters. They want to pay maybe a premium rent for the unit so that higher rent can achieve higher net operating income. So before we can get a low amount, we should always think this before we are thinking about financing. And that is more important than just have a piece of land and then I want to fit in this loan program. It's
Right.
not like that way.
No, that makes perfect sense. And again, I think really what you're describing is your feasibility study is going to, as it says on the screen, demonstrates confidence, but there's confidence to the developer to know the developer is building the right product for the target resident profiles for their specific site. But it's also about demonstrating your confidence, strong market data to support going after financing. So you've got to give the lender and CMHC the confidence that you've got the data and the expert recommendations to achieve the financing program that you're looking for. So yeah, confidence and credibility is not only important for the developers group, but it's for the application process with the city and the city planners, but it's also with the financiers. So yeah, really very important. And I think you've answered the question. Noor has asked, what is the minimum equity for CMHC construction loans? Well, under a perfect scenario, that could be the equity could be as low as 5%, but
Mhm.
you've got to check off an awful lot of boxes in order to achieve upwards of 95% loan to cost. So,
Yeah.
um,
I've seen a lot of cases they have like they got approved at 90 to 95% loan to cost means the minimum equity required would be just like 5 to 10%. That is very common, but it depends on where your project is. In different province, the number might it doesn't add the same way. And even for like different experience level for developer, they are different. Like for some developers, they are very good at stacking at those, let's say, city incentives. City may give them like 1 million incentive for them to build their project if they commit some sort of affordable following the city's requirement, or they may get like achieve get some development charge waiver for their certain like for their affordable units, which can lower their construction costs as well. So keep in mind, so the minimum requirement is a number that comes from project cost minus the maximum loan amount. So those can like those two numbers can change the equity required for a project. But people always would like to find can start as like a minimum equity as possible, but we need to make sure the project itself worked from the pro forma perspective.
yeah, and I think to kind of frame it up, Rod's example that he demonstrated uh, to our audience at that 75-25 split is a good way to frame up how you should start looking at it, and then seeing if you can work into a scenario that gets you access to higher leverage. And again, that's based on many factors. And I think to that point, let's skip to the next slide about considerations because Joanna, you started talking about some of what CMHC requirements are, and they're being a lot stricter than in the past. So maybe talk to us a little bit more about that. And Joanna, sorry, right before you do that, I just want to comment on what John has just asked about. Working with developers that build senior or retirement residences. Just to answer that very quickly, those two things are very different. Retirement residences are very different from a seniors oriented building. Um, you know, Seniors buildings are considered to be conventional purpose-built rentals. They're just constructed and designed to resonate more with that active senior profile. And yes, we do absolutely work with developers that are building senior oriented residences. And Joanna, I think you've done a lot of underwriting and supplying financing options for seniors oriented builds.
Right. Yeah, exactly. That's a very good question. A lot of people just confuse the retirement residence and the senior oriented residence property because when we underwrite the senior oriented property, we underwrite under the standard rental program, not with those senior like retirement home. They are like different. Those retirement home, they require more operating experience for how you operate to they usually provide some sort of services to those seniors, so it's quite like different, but
Yeah,
that is
higher
the
level of
yeah.
regulations and requirements. There's mandatory pieces that are not required in a seniors oriented business or development. But Joanna, maybe now you can talk to us about what those requirements of CMHC are.
Okay. So like for I think we've covered a lot here and I've answered some questions. So here I would like to just like mention if we are developing in a secondary market which they have like less like smaller population, CMC sometimes we are need to consider uh, sometimes they may require you to provide some third-party reports in regards how will be the absorption rate of those like market. Let's say you just like jumping like 100 units in a small town. it may take you 2 years to make the like get them like all the units list up. So that is a question they are considering because I've got a lot of requirement from developers who have like a pro forma to me in a secondary market, which the numbers seem very good because lower land costs, higher rate, higher rent. But however, we need to consider if we put so much supply in a small town in a time, how long were all the units being listed up, and then we can stabilize. And lender look at that as well. So
Yeah, directly relates to the takeout financing, right? Ideally, you want to have a sight line to take out financing, well, 12 months after certificate of occupancy, right?
right, exactly. So sometimes when usually will be like first time developer when they see the report from the absorption rate is like very long, they sometimes they just say, okay, I'll forgive this deal. I'll go to another place to find a better deal. So this is like what we can consider. So just like think lender and CMC as your financing partner, once your deal pass from financing, which means your a lot of numbers works and you are more safe to get your deal to be get your project to be built up and to achieve like better return.
Right.
Yeah.
Now, one thing that we get asked is, you know, and this is part of the apples to apples comparison. Maybe talk to our audience about the difference between a feasibility study compared to an appraisal and the practical application of both.
Mm-hmm. I've seen the appraisals usually can be affected by the developer themselves. Like developer always have very higher expectation of their market rent. Sometimes appraiser can support them, and we underwrite the loan in higher rent. However, when we submit the loan, we got cutback from CMC or from the lender, which they are saying, okay, your appraisal report is too aggressive. The rent you're not going to achieve. So the thing is not like whether we're going to have a bigger loan size to support our construction, but also is how reasonable is we are going to get our income generating to support our such a big loan amount in during the takeout term. So it's really, I think like every developer should think about these questions before. Let's say you are expecting a higher rent, higher than the comparables. You will need to figure out how you are going to achieve this rent. Let's say if you are located in a better location or you are providing better amenities can attract high income renters. So this is we should think about how we build this building to achieve the rent in our appraisal report. That's very important for developers to keep in mind.
Yeah, makes sense. And we've touched on this a little bit. The lease up game plan is so critical to uh, achieving, a successful financial outcome, but also to secure your takeout financing. When do you believe that a developer should start commencing their lease up plan?
Usually I would see a lot of them start from 3 months before, especially for larger units, but that really depends on different experience of the developer. But I would say the earlier the better. If you can just fix a lot of lease before the completion, that would be better.
Yeah, and I think to your point, as early as possible, getting your website set up and getting your awareness campaigns out there early, well before certificate of occupancy. You've got to start drumming up that priority waiting list and interest in the property. So yeah, I think your message is the right one as a takeaway is get that going as early as possible, even as far out as soon as the hoarding goes up, right? Part of your lease up plan is the marketing. When the hoarding goes up,
Yeah.
get your hoarding banners up and start drumming up interest and make sure people know this is a rental property that you can rent here. This is not necessarily a condo, right? So get that messaging out early. It ties directly into your lease up plan. Now, to kind of wrap up the slides, anything else that you want to talk about in terms of CMHC and there has been more
Right.
strict developer requirements.
Yeah, this is like a question I've been asked a lot. It's like how, so in term, if you are build, if you have already, especially if you want to apply a CMC insured construction loan, because construction loan always take higher risk than a term loan, because term loan you don't have build up risk for the construction. You don't have construction risk. Um, and so if we are applying a construction loan, CMC right now, they are very strict on the developer's requirement. If you, they need to understand what are your expertise in operating this kind of projects. Have you managed this size of property before? And and also they right now very if you have good experience, okay, you can have like lower personal net worth or like liquidity to help them approve your loan. So they are not approve this loan just under the numbers, and everyone know that the CMC require the personal net worth guarantee should be at least 25% of the loan amount. However, that is minimum. I would say for very experienced developer, when you hit this and you present other experience, then you may get approved. But for first time developer, it's not always you can get approved in this. Usually lender or CMC will say we are not comfortable with your experience. If they're if you're getting this message from the lender, what you can do is maybe bring in some more like guarantor with you, providing more personal net worth for the loan guarantor, or getting more experienced team in your sponsor team to showing you have more experience in terms of this type of thing. So basically, when we apply for a construction loan to get it approved, is a full story. It's like how we made every piece together to get our loan approved. But if
Yeah.
you build up the property, you're just apply for a takeout loan or a term loan, that will be much easier. It's just like usually I would say 25% personal net, like loan amount of your personal net worth would be enough. So that's what we should consider if you are pursuing a CMC insured construction loan. There will be more piece we need to put together to get you approved with the loan.
Right. And you've touched on some interesting points, in terms of bringing in an additional guarantor that might be necessary or possible. And we're going to get into some of those creative deal structures. And, you know, you really highlighted the reason why you've got to go deep into financial modeling and mapping this out, because you have to keep an open mind. And if you don't have the equity required to secure the construction loan, you're going to have to think creatively, and this is a well mapped out process to figure out, okay, who do I need? How do I put all the pieces together in order to get this project moving? And later on in the webinar series, we're going to tap into some of those creative deal structures that will help a project get going. Because a lot of times what I'm seeing, and Joanna, you're probably seeing the same thing, is a developer gets to the point of going for financing and they get declined by CMHC or one of the lenders. And what do? They stop. But a deal doesn't have to end there. So,
Right.
later on in this series, we're going to talk about how that works and how that happens. We're working on a number of these jointly together right now as we speak. So, you know, just want to throw that out to our audience that a deal doesn't have to end just because you didn't get your financing on first pass. So later on, as a reminder, we took care of the basics today. We're going to get deeper into the development pro forma and really get granular with that data. And then later on, more CMHC options. And then, like I mentioned, getting into creative deal making with equity, joint ventures. And in part five, we're going to go deep into private equity. There's a lot that can be tackled there. A lot of options, optionality is critical. So, stay with us, right? The next iteration of the webinar series is on May 28th. Um, and yeah, just keep joining us. We're gonna add the layers on, and I think we tackled everything that we want to tackle for today's webinars, but for today's webinar. Now, with additional questions, challenges, project specific, you see that my QR code is up there to book a time with me. So we can talk about your project. Feel free to reach out to me via cell phone, email. Uh, I can pull in our team as needed for your specific project. So don't hesitate to book a time with me with any challenges that you're currently having. And to stay in touch with what Rock Advisors is doing. And as mentioned, we've got a number of free webinars coming up, plus our live event at the end of the year on December 1st. If you're not plugged in, use the QR code that's on screen right now to get plugged in to find out when our next events are coming out and get access to our educational series, tools, and events and white papers that we have to offer. Plus, again, don't forget about the National Apartment Council in September. They've got their AGM. So, thank you everybody for joining us. This is hopefully been a good foundational piece for you, and don't hesitate to reach out with questions. And
Thanks,
thank
Dave.
you to
Thanks, Joanna.
Rod. Yeah,
Yep.
appreciate you joining us today. Some good information.
Great. Have a great afternoon, everybody.